like accounting is just a bunch of numbers, playing hide and seek with your sanity? Well, grab your calculators and buckle up. We are about to turn those confusing concepts into your new best friends. Think of accounting as the GPS of business. Without it, you are just a lost enterprise, isn't it? Asking for directions in a foreign language. So, today we are making the journey from accounting anxiety to financial fluency, and I promise it will be more fun than balancing your friend's restaurant bill when everyone wants to pay separately. First up, capital, the foundation of your business building. Capital represents the owner's investment in the business. The stronger your capital, the less your business wobbles when economic winds blow, isn't it? For example, when Krish starts his business by investing 5 lakh rupees in cash, that's his capital. When he contributes a building worth 15 lakh rupees as an investment, it is capital. When someone invests his existing inventory and equipment worth 5 lakh rupees to start any business, you know what it is? It is capital. So without capital, a business is like smartphone with 1% battery, not going to last long and will shut down at the worst possible moment, isn't it? And then next comes transactions and events, the building blocks of the accounting universe. The transactions are specific business activities that can be measured in monetary terms. Think of them as the ingredients you put into a recipe. For example, a mobile shop dealer buys 50 smartphones from Samsung wholesaler for 5 lakh rupees. That's a transaction. When a beauty salon receives 2500 for making someone look fabulous, transaction. When a shawarma traders pay 20,000 monthly rent to avoid becoming an open air market, you guessed it, transaction. So now, what is event? Events are what comes out of the accounting oven. They are outcomes resulting from the transactions or external factors. Remember, if money changed hands or can be counted in rupees, it's probably a transaction. Whereas if it's the result or outcome, it is an event. The next step is assets. Your business collection of valuable stuff. Students, assets are resources controlled by the business which are having future economic value. Think of assets as everything valuable your business owns. If you had to sell everything tomorrow, these are the items you would list on OLX or eBay, isn't it? So here we have got the classification, tangible assets and intangible assets. Tangible assets are those things which you can touch and occasionally sell also. Whereas intangible assets, they are the assets which you can't touch but are still valuable, like software licenses, the trademarks. Understanding? So the rule is if it is valuable and your business controls it, congratulations, you have got yourself an asset. The next terminology, liabilities, everyone's favorite accounting topic. Just kidding about the favorite part. Liabilities are the obligations that will require future payment or services. Think of liabilities as IOUs, that is, promises your business has made to pay someone else in the future. So there are classifications like current liabilities, non-current liabilities. The current liabilities are like your Netflix subscription, which will be due within one accounting year. Or other examples could be outstanding salary, trade payables, bank overdraft. These are current liabilities. Whereas non-current liabilities are the long-term commitments like that 5-year gym membership you optimistically signed up for. These include, non-current liabilities include that 5-year term loan from bank or debentures worth 5 lakh repayable after 3 years, or employee retirement benefits. So these are the examples for non-current liabilities. The next terminology is sales and revenue. Moving on to everyone's favorite part of business, sales and revenue. The money coming in. Sales specifically refer to income from selling goods or services that are the primary activity of your business. Like when a bookstore sells books worth 15,000 in one day, or a clothing retailer makes sales of 2,50,000 in a week. This is sales. Where revenue is a broader term that includes sales plus other income. It's the whole meal deal. Revenue includes those items like rental income, interest income, royalty income. So sales are like the main dish on your business menu, while other revenue sources are the delicious side dishes that complete your financial feast. Now the next part is the money going out, expenses. Expenses are costs incurred to generate revenue during an accounting period. Think of expenses as the fuel you put in your business vehicle. Necessary to keep things moving forward? Yes. Without expenses, your business is going nowhere. But too many, you will run out of money before reaching your destination, isn't it? So these include monthly staff salaries, electricity bills, advertising cost, insurance premiums, all those things that make your business function. Remember, expenses are necessary, but like spicy food, too much can cause discomfort, isn't it? The next part is profit and loss. It's time for the scoreboard of your business, profit or loss. Profit occurs when total revenue exceeds total expenses, like when your team scores more runs than the opposition. Look at the example of fashion retailer. The total sales is 5 lakh. The cost of goods sold is 3 lakh. The operating expenses is 1 lakh. So in total, the total expenses comes around 4 lakh. So the profit is 1 lakh. Simple accounting equation. Whereas loss occurs when total expenses exceed total revenue. Like when your cricket team falls short of the target. For example, sales 2,50,000 and expenses is 2,80,000. The loss is 30,000. So in the game of business, profit means you are winning while losses means it's time to adjust your strategy. Remember, even the best businesses have bad innings occasionally. And the next term is discount. Let's talk about everyone's favorite word, discount. Discount has various classifications. First, trade discount. It is a reduction in a catalog price for specific customers. The key thing is it's not recorded in your accounting books. Suppose if the distributor sells goods with a catalog price of 10,000 to a retailer with 20% trade discount. So the list price is 10,000 and whereas the trade discount is 2,000 and the net price is 8,000. Only that 8,000 makes it into the accounting records because the discount never existed as far as your books are concerned. Like that extra samosa you ate that nobody saw. So whereas cash discount is for prompt payment and it is recorded in the books. It is recorded in the books. And whereas quantity discount is another type which rewards buying in bulk. So remember, trade discount is a special pricing for being a business customer. Cash discount is your reward for prompt payment and quantity discount is your bonus for bulk buying. Discounts making accountants happy since forever. We shall be continuing the few more accounting terminologies that you should know before starting your accounting journey. So until then, please like, share and subscribe our video and wait for our next video. Thank you.